Warning signals have been set off all over the world. We're not in 2017 anymore. The entire markets have seen wild swings in either direction as of late, signaling turbulent times and more woes ahead. How do central banks create more stimulus in the economy without showing the obvious weakness that is present? You came here for the truth, so let me unveil that for you. Today we're going to look at several factors. I want to begin with the markets. We're going to take a look at some indicators here. I want to show you what's happening in Europe. I want to show you what's happening in Turkey as well, Canada, and so much more. Let's begin by taking a look at this. The S&P 500 is consistently around this 2,800 mark. It has been flirting with this number since 2018. It's been up and down along the way, but this is a very important resistance. If it breaks through here and maintains that for a long period of time, perhaps they can actually break this long-term downward trend that has been seen. What we saw from basically September, October into the end of December was very different than what happened throughout 2015, 2016. There was some loss that was experienced during that time frame. However, it didn't break the trend. And now, however, this has been a different case. 2018 showed us that without the quantitative easing at always increasing rates, there is no possible way that these markets can be sustained. So we'll look further into this. I wanted to show you what's happening here with the 2,800 level specifically. After looking at the charts, Capillari argues that the S&P has been stuck in a range. He doesn't forecast new highs until the index can materially break and hold above the key 2,800 level, which has provided resistance in the past. That's basically what I just said a moment ago. By my count, it's encountered this level or this area near 2,800 now 12 times since the beginning of 2018, and I know back then it marked a key breakdown point twice in January and again in October. It's in a rebound form now, and so we still need to get through that point, and this is very important. So once we see it break past 2,800 and not 2,801, not 2,850, we need it to go towards that 2,900 mark and remain there for a period of time. It doesn't necessarily need to shoot up there in a day, but it has to go slowly but surely. There'll be ups and downs, just like any other market that occurs as time goes on. They move up, they move down, they move sideways, but it needs to go beyond that for them to actually start seeing this as being a support. Right now, that's not the case. One important economic indicator is the semiconductors, and this is the Fed's beige book. I've shown you this multiple times. This is from March of 2019. There's a lot of detail in here, but I just wanted to read you something very quick, and I will highlight it for you. They're talking about semiconductors here. The semiconductor firm sells mostly to the auto industry and said that a 40% drop in the new orders from China was the biggest fall in sales since the collapse of Lehman in 2008. Two other firms, both with heavy exposure to semiconductors, said that the market had slowed significantly since earlier in 2018. Those are just a couple points that I wanted to make. The beige book always being updated. It gives you some details as to what they're seeing out there in the economy. But essentially, always keep an eye on these different semiconductor companies because they are able to foreshadow what may happen in the future. This happens to be one here. Infineon Technologies macroeconomic woes weigh on business expectations. They had to bring down their expectations here, and that's obviously very negative for that stock. It dropped the last time I checked it, but I just wanted to show you one specific example of how that works. We've got these yield curves in the United States that are inverting, and this has been the talk of the town, but it also happened in Canada. In this case here, the Globe and Mail tells you that you do not need to panic. Literally said this. Canadian investors shouldn't panic about the inverted yield curve. This is when you know that you should probably panic. When they're telling you that the air is safe to breathe, you know that it probably isn't. So this is what happens when we can see the media coming in and try to put out the flames, put out the fires, but they only make it worse for those who are actually paying attention. In connection with that, we have this article here, and they said this: a rate cut would require signs that the economy is declining. The inverted yield curve is troubling. Inverted curves have often been accompanied by recession. So 2 points there. Number one, the fact that a central bank, whether that's Canada, whether that's the US or any others, they have to be able to provide stimulus, and they do so through the central banks. They can cut interest rates. But when you cut interest rates, you're basically saying we are not doing well, so we need to provide stimulus. So they're kind of stuck, they're trapped, they're in the corner, they don't know what to do, but they can only let it go for so long. That's usually what you see with central banks. They react too slowly and too late because they're in this fight. They don't want to be there dropping down the interest to zero or even to the negative, because that signals to the markets, okay, we're hurting really badly. At the same time, they want to provide that stimulus. So this is the trouble that they're in right now. It's in Canada, in the US as well. And of course, the yield curve inversion is just another indicator, one of many. We shouldn't focus on it too much, although it's happening right now. It's in the media, so I'm covering it. But I also show you so many others that I believe people should be watching on the regular basis to be able to know what's happening. And at the very bottom, signs of a global slowdown are real. This certainly puts the Bank of Canada on hold. Of course, they're not going to increase interest rates anytime soon. That means mortgage rates will probably stay put. Maybe they'll bring them down somewhat to try and stimulate a little bit of that real estate market, which has really been soft compared to what it was just a couple years ago here in Canada. I'm looking to see what happens as more inventory builds up throughout this period of time. Will we get increased sales, or will it be a buyer's market? We'll see. I will of course cover that on the channel. ECB studying tiered deposit rate to alleviate banks' plight. Okay, so check this out. The ECB is studying options to lower the charge that banks pay on some of their excess cash as a possible way to offset the side effects of its ultra easy policy. At the very bottom, negative interest rates effectively mean that banks pay the ECB to park their excess liquidity safely with it overnight. So they did one measure by imposing negative interest rates. They realized that really screwed up the banks, and now they're going to go and put another band-aid on top of that. This is madness. Absolute madness. Well, the bank stocks loved it because they shot up immediately after that. You can see on the chart here. Who knows what'll happen tomorrow? Deutsche Bank could be merging with Commerce Bank, and it's going to create this mega bank, and it's going to save the world. Actually, it's going to make things worse, but that's another topic for another video. I had to triple check this because I couldn't believe what I was reading. Turkish stocks dive and key interest rate hits 1,200%. You heard me correctly, 1,200%. Turkey's benchmark stock index dropped 5.2% and was on track for its worst day since July 18th. So here's the story. The slide in Turkey's equities market came as the government directed the country's banks to withhold lira liquidity from the offshore swap market in an attempt to keep the lira from falling sharply. This sent the overnight Turkish swap rate to 1,200%, by far the highest ever. I have no possible idea as to how they're ever going to come out of this. What in the world are they thinking, trying to completely manipulate their system and get away with it? It doesn't work. This is going to end very badly, and unfortunately many people are going to be burned because of these actions. As you can see, as time goes on, these central banks have engaged further and further into their manipulation, and now they're at the point where they realize they screwed up big time, but they can't reverse their policies. That's not Turkey, that's not the US, it's all of them. They're all doing it. Every single central bank has manipulated their currencies, the monetary system in some way, and there is no reversal process. It has to collapse, and then they come in with a band-aid, and that's what is going to occur at some point in the near future. There's no possible way that it will ever work itself out because they're using the same bad policies which got them in the last place last time, and this is just going to end up the exact same way. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you are supporting this channel, so I do appreciate that very much. Well, last but not least, if you want the financial education you weren't taught in school, these 2 books have everything you need. You can get all the details at the link in the description, talking about the foundation, the history, the asset classes, so much more. Check it out. I make it easy for people to understand, to get into this. I break it all down. I use diagrams, I use charts. I make it simple, and I get rid of that financial jargon that is often there, really just masking you from understanding the truth. It's actually very easy when you break it down and simplify it. That's what I did in these 2 books here. Click the link if you want the audiobook that's available at themoneygps.com. If you want to find out what the Federal Reserve is up to, you got to watch this video, so click on it and I will see you there.